Well, greetings, my beloved clients and friends. So today is February 5th, I believe, and we wanted to do a market update. Right now, we're in the middle of earnings season, and earnings are generally coming in not too bad. And in addition to that, last week, Fed Chair Powell raised rates for a seventh consecutive time. This time he raised rates by 1/4%. So he started raising back in March of 2022. And at every meeting since then, he's raised rates. First one was 25 basis points. The next one was 50. Basis point is 1/100th of a percent. So 50 basis points is half of 1%. And then 4 3/4 point increases. And then he started slowing down to 50. And then just recently, last week, he raised rates by another 1/4. Okay, so 7 consecutive rate hikes is not at all normal. Last time we had this big rate hike season was in 1994 with Alan Greenspan, and he raised rates 6 times. And it wasn't as aggressive as this. As far as there weren't like 4 3/4 point hikes. You'd have to go back to 81, 82 when Paul Volcker radically raised rates to have anything comparable to what we're in right now. And he took rates up into the teens. And people remember that they could get 12, 13% CDs, and mortgages were like 14, 15%. Okay, so, and that was 40 years ago. So it's not something that happens often at all. And by the way, those other two, guess what happened afterwards? After, when Volcker had finished raising rates, there was an era of incredible growth and prosperity, the Reagan era, throughout the 80s, and it really continued throughout the 90s. This long stretch of very good economic growth and market performance. Same thing after Greenspan did it in 94. I remember vividly because it was early in my career. 95, 96, 97, 98 were phenomenal times of economic growth and market outperformance. So it seems like we're getting to the tail end of this one. And it's possible that if he does it right, we could get back to a nice period of economic growth. And the market seems to be acting favorably recently. And there are a lot of concerns and fears, and I'm going to just say it, the R word, a recession coming this year. And I want to just give some color to that not all slowdowns are recessions. So imagine if you were going to go to Vegas and you're driving to Vegas, you're going up the 15 north, and once you get out of the city, it kind of opens wide up, and it's just a straight line through a lot of nothing. And you're going 75 miles an hour, and people are passing you, so you're going 80 and 90, and the freeway's pretty much open, so you say, well, let's have a little bit of fun. And you take it up to 100 miles an hour, right? Which is fun, but it's not safe. It's not good for the car. You risk getting in an accident, you can risk getting a ticket, you get risk throwing in jail. You're not getting good fuel economy, but it's fun. And then you think you see a cop, and you slow down to 70. Okay, that would be considered a slowdown. Now, you go to Vegas and you have fun and you're there for the weekend, and it's Sunday and it's time to go home, but you're having fun and you're doing good, so you stay a little longer than you had planned, and you end up leaving at about 3 like everybody else, instead of early like you had planned, and you get back on the freeway and you say, well, I'll just drive fast and I'll get home like I drove coming up. But guess what? There's traffic, right? And you can't drive 100, you can't even drive 70, and you're lucky if you're driving 40, because now you're in a real slowdown, and traffic has really slowed down. So I said that to give you an illustration that there's a difference between slowing down from 100 to 70, which is where you really should have been, and slowing down from 70 to 40, which is now you're stuck in traffic. Worse yet, slowing down from 40 to 10, where you're in, bumper to bumper traffic. I mean, practically a dead stop. There's a difference, okay? And so there's fear of a slowdown, but I want to tell you that it's a slowdown from 100 to 70. In 2021 and the early part of 2022, when Powell had to start tightening, the economy was going at 100. There was so much cash in the economy, and everything was blowing up. The stock market was blowing up, and within the stock market, the most aggressive and risky parts of the stock market were going up the most. Cryptocurrencies were going up. Housing market was going up. Collectibles I talked about before, like Vine watches and Rolexes, and you could buy a car, drive it off the lot, and sell it for a profit. I mean, and people were working from home, working in their pajamas, working part-time, and because why? Because there were so many jobs that your boss didn't dare call you out. And I heard that there were people that had multiple stay-at-home jobs, and that's just not normal to get paid that much to work part-time, or to get paid that much to do nothing on the internet, or to do literally nothing with the government sending checks, and sure, it feels good to drive 100, and it's exhilarating. Your kids are in the back of the car going, yeah, Dad, and taking a picture of the speedometer and a selfie, posting it that they're going 100 miles an hour. But it's just not sustainable, and it's not healthy, and it's not safe. And so he had to slow it down. Okay, what else is not normal? It's not normal to have 3% interest rates on a mortgage. That's unheard of. And it led to this huge housing boom. It's not normal to have 0% interest rates on a bank account. It's not normal to have 3.5% unemployment. It's too low. I've said this before, there's this old joke about the 3-6-3 rule for banking, which is borrow at 3, lend at 6, and be on the golf course by 3. %6 mortgages are normal. 3% CDs are normal. Going back 70, 80, 100 years. So if you are lucky and fortunate enough to have locked in on a 3% mortgage, you should thank your lucky stars, because that's just not normal. So now that Powell has raised rates and mortgages are back up to 6, guess what? That's normal. There have been many, many healthy economies and healthy real estate markets with 6% interest rates. And it's like if you own an apartment building and you're 100% occupied, that's not the most efficient. That's not normal. It's better to be like 94 to 96% occupied, because then you could raise rates. Morning. If you're 100% occupied, you're probably charging too little, right? So it feels good to go 100 miles an hour, but it's not necessarily what's best. Okay, and what Powell's trying to do is slow the economy back down to 70 miles an hour without dropping it down to 40. But that's the risk, that he slows it down too much and it drops down to 40. But so far, he has been able to slow it down largely from 100 to 70, and it has not yet slowed down to 40. Okay, so that's why the market is encouraged, and it seems like it's possible. And the bond market seems to be optimistic about it, because we've talked about he can only raise the overnight rate, the shortest end of the yield curve, and he's raised it by 4.5%. In that same time, from March of 21 to now, the 10-year has gone from 1 3/4 to 3.5. So even though Powell's raised the short end 4.5%, the 10-year's only gone up 1 3/4. It hasn't gone up as much. So it's not affecting mortgages and long-term borrowing nearly as much. And it's not slowing things down as much, because the bond market feels confident that inflation is under control. And it's a good sign when you see that. And people are worried about, wow, the yield curve is inverted. Of course it's inverted, because he's raised the short end by 4.5%. And the long end didn't want to go up that high. If the long end had gone up 4.5%, it would be signaling, yes, inflation is a problem. But the long end did not, signaling no, inflation is not a problem. And there's a good likelihood that we could end up at normalized rates and effectively driving at 70. Okay, so I just want to say that so that to put into perspective the slowdown that we're in. It's not a slowdown from healthy, sustainable 70 down to 40. It's a slowdown from a unhealthy 100 miles per hour down to a more healthy 70 miles per hour. To a, and so what does that mean? Kind of that the party is over, that you can't just make money buying a used car for retail from a dealer and sell it, that you can't make money just sitting around in your jammies all day. And it's because if there's an economy that people are all making money sitting around in their jammies working from home, there's gonna rise up another country or company or competitor that's saying, I'm actually willing to work, right? And it's gonna eat our lunch. So this party really has to end. And we do need to get back to normal. And that doesn't mean that we're gonna drop into a recession. If they raise rates too much, they hold them too tight, it's possible, but for now, he's just trying to get us back down to normal. And so what has happened is that first the speculation ended. The speculation in the stock market and crypto and NFTs, that ended early in 2021. Speculators were the first ones to get out. And then around April, you saw it affect like those other things like I saw it in jewelry and Nikes. And then by about June, the speculators in housing had kind of called it quits. Because that's not normal either. It's not normal to put your house up on the market and the very first weekend to get 30 offers, 100,000 over your asking, right? That's not normal. So we had to get back to normal. It's normal that when you're going to try to sell your house, it's on the market for 30 to 60 days. That's normal, right? And now that's what we're back to. And you're getting, and you get to, the buyer maybe has a little bit of negotiating room that he doesn't have to pay $100,000 over asking. You know, maybe he gets a fair shake too. That's more normal, right? We're not saying we're going into this housing crash. We're taking housing from 100 miles an hour back down to 70 miles per hour, not to zero, okay? And houses are selling. I was looking at a couple properties about a week ago, and I didn't get them because someone else bought them. And I don't think they paid 100 over asking, but you know, it was a relatively new listing, and so I mean, properties are moving, not at this frenzied pace that we were in a year ago, but at a more normal, like I said, back down to a more normal market, which is really better long term. Okay. So yes, the slowdown is welcome from 100 down to 70. Now, am I saying for sure we're not going to get down to 40? No. But there are some signs that are encouraging. What is a recession? A recession, well, technically it's 2 quarters of slowing economic growth, but really on the ground, a recession is people looking for work, right? People that want to work, and they're looking for work, and because they're looking for work, they spend less money because they don't have money, and maybe if they're out of work for too long, they can't make their house payment, or they can't make their car payment, or they start defaulting on their obligations, and they spend less, and so the economy slows down. That's what a recession looks like, right? But what's the situation right now? We're not in a situation where people are looking for work. We're in a situation where work is looking for people. We have a shortage. So first we got to get that market into balance, right? So the labor market, if you will, is going at 100. Still, Powell has slowed down a lot of the other things. The stock market, he slowed down the real estate market, the speculation market, and corporate America has slowed down too. Labor is still going faster than 70. So it has room to go down back to normal before we're talking about recession. Okay, so and that's why that's still inflationary. Okay, so yeah, he still needs to slow down the labor market. But by slow down, I don't mean recession. I mean slow it down from too hot back down to normal. Okay, so I just want to calm some of the panic, because there's panic of a slowdown, and it's a slowdown, like I say again, from too hot. It's a needed and welcome slowdown, and a healthy slowdown. Okay, and the market has kind of reacted positively in the last month because there's the hope that it could end there, that basically get us back down to driving 70 without creating a traffic jam. Get people back to work, get the housing market back normal, where, you know, it takes a month or two to sell your house and you get close to what you asked for, and the person that buys it gets a 6% mortgage. That's kind of normal. What would be bad is if, man, you try to sell your house and it stays on the market for 9 months, and you have to lower it and lower it and lower it, right? And the people borrowing are borrowing at 8 or 9. That would be bad. We're not at bad yet. We're going from hot back to normal. Okay, bad in the labor market would be unemployment at 6 or 7 or 8. If unemployment went from 3.5 where it is now to 4 or 4.5, that's not the end of the world. That's very healthy. That's very normal. That's back to 70 miles an hour from the super hot that it's at right now. So what would be a potential risk? I'll give you an example of a risk. So let's say there is concern about the labor market. And I said before, we're short of people. And let's say, I said, okay, we do have a hot labor market. We are short people. We are gonna let in 100 people a million people. We're gonna let in 1 million people, immigrants, to fill those jobs. And they did that right at the same time that corporate America was in the process of cutting out those 1 million jobs. Right? They waited too long to bring those people in. That could happen. And it kind of, Powell waited a little bit too long to raise rates, and now he has to be super aggressive. So, but I doubt that's going to happen. They're not going to let 1 million people in. But I do believe that corporate America is going to tighten up. They're going to make people start working again. They're not going to pay them these crazy prices to do nothing. Like I said, going back down from 100 miles an hour down to 70. That doesn't mean it's a recession. Okay. So I just want to say that so you could be encouraged and be hopeful that not all slowdowns are bad. A slowdown from too hot back down to normal is actually good. And the market, I believe, is viewing it that way. The concern is that this slowdown will continue and go from too hot to good and then down to too slow. So, we're cautious. We're not declaring victory yet, but we're cautious, but we're actually cautiously optimistic. Okay, so I hope that gives you some perspective. And I'll give you an example. So Tesla was decimated. Our largest holding was decimated in December. It was down over 40%. But guess what? In January, it made it all back. It's back to where it was on December 1. And it's still not overpriced. It's still relatively, I wouldn't call it dirt cheap, but it's fairly priced. It's still not overheated. Okay, it had gotten pretty cheap. So be encouraged that the slowdown we're in is actually a good thing. If it continues to slow for too long, it could become less of a good thing, but we're keeping an eye on that, and we're managing accordingly. And we've had a nice recovery in the last month plus. But we're still maintaining a level of caution and level-headedness. It's what you pay me to do. All right, so have a great day.